Massive insider selling is what we are focusing on today, where insiders have sold at least $5 million worth of shares just over the last 7 days. And the first one we want to draw your attention to is Salesforce, where the president and the COO, the chief operating officer, on the 22nd, so just 5 days ago, sold around $5 million worth of shares in the company. Now that is quite a big position, president and COO, so let's take a look, understand whether or not we agree, and we do believe this is now significantly overvalued. We're going to run through 3 today. Salesforce then itself is up 47% over the last year, massively outperforming the S&P, although a little bit of weakness today, down 4%. Over the last 10 years, if you have been a shareholder, you would be up more than 462%. That has outperformed the S&P and would be even higher if you did reinvest the dividend. We can see right now it is trading towards the upper end of the 52-week range with a double buy signal from Seeking Alpha in Wall Street. Now, Quant do give it a hold at 3.47. Bear in mind, 3.5 would turn this into a buy, so not far for them to flip it over into the green. Now, forward P does look fairly high at a first glance at 34, and we also notice it does pay a dividend, but the yield is fairly low at 0.47%. Now, in terms of moving forwards, they do anticipate green right across the board. That is, in turn, growth to the earnings per share over the next 4. And we do like to see this 100% track record over the last 4 quarters. They've outperformed management targets. And in turn, they believe the earnings per share over their next full accounting period will increase, which will lower the forward P to 30.71. Now, in terms of their dividend safety, we get a score of 80. We'll cover these 2 models, but as they've only just started recently paying a dividend, we don't have any increases from this company just of now. In terms of dividend safety, well, as we can see, initiated in October this year, so the rating doesn't have too much behind it, but we can note a dividend cut at a first glance for Salesforce is unlikely. Now, their key metrics from the 07-09 recession crash: no dividend paid, no comparative data, but their sales were very strong, plus 21%. That is well above the average of the S&P, which was actually negative 12% in 07-09. Then we get to the first valuation, which is based on the 5-year average of the P ratio. Bearing in mind the blue tunnel is the expected fair price, is that this company over the last year has been severely undervalued. Just look at that gap, not something we see typically on this channel. And right now the gap has started to close, but this model still shows undervaluation even at today's value. Remember though, we don't look at any one of these models in isolation. We will conclude when we get to our own valuation shortly. Now, dividend yield theory, it does tell you a company is undervalued when the current yield sits above the 5-year average. They've just recently released a dividend, so this isn't appropriate to use as of today's date. But on a more appropriate metric, the forward P, right now at 31.7, that is below the 5-year rolling of 36.6, so that would be classified as an undervaluation signal. We do, however, note it does trade at a premium to the information technology sector, which right now is at 26.4. Whether or not it does deserve that premium is something you should consider, and as always on this channel we do add a margin of safety to our valuation. Free cash flow, always something we draw your attention to over the earnings, which is susceptible to manipulation by management through accounting, and below 60% is our typical free cash flow payout maximum threshold. Reason we use this is to give us faith management can increase those dividends at a very attractive rate. We do anticipate that in 2025 with Salesforce, given the ratio is very low, 13% expected over the next 12 months. Now, we want to see on the free cash flow graph consistent increases over the long term, and this is probably one of the most consistent we do get on this channel, 122 to 975, so that is also a very strong increase over the last 10 years, and over the next 12 months it is expected to go significantly higher to $12.70 per share. In terms of sales growth, 2 things that we notice here. Firstly, double-digit growth every single year, although we have seen the trend where it has started to decline from 2020 at 29% and on a trailing 12-month at 10% is noted. However, at a bare minimum, we do want to see 3 to 7% 3 to 4 just to keep up in line with inflation. So nice to see Salesforce is significantly higher. Question is this slowdown just something that is a one-off and can they turn it around, or are we going to expect their revenue to start increasing in the single digits? When we do zoom out and look at it, we do notice it is up sevenfold from 5.4 billion in 2015 to 35 in 2024. And we do also want to point out that they have diluted your position as a shareholder over the last 10 years. What we typically want to identify here are companies that return excess cash through those share buybacks. In fact, Salesforce, we want to see this flipped, but they've done the opposite. They've been issuing shares over the years, but maybe you wouldn't care too much given they have outperformed the S&P during this period. We then move on to the ROIC. We want to see 10% or more just to give us faith management are able to effectively allocate their capital. Not something we see over the longer term. In fact, they've only hit that on a trailing 12 month. Definitely an area that for me isn't something I like. This is one of my most favored metrics where I do want to see that number on a very consistent basis. We then move on to the operating margin where we want to see at least 12% as a minimum. We get that in 2024. The other thing we want to see is operating efficiency, not just revenue increases that Salesforce show, but also the same on their margins. Looking very inconsistent. They've been through a very large patch. In fact, 9 of the last 10 years, well below that. Definitely something I would keep my eye on if I was someone that was invested or in fact considering investing in this company. No issues whatsoever though with the free cash flow margin, not only increasing, but also some very high numbers. 32% is noted on a trailing 12-month basis. We then move to the net debt to EBITDA. EBITDA refers to the earnings before the interest, tax, depreciation, amortization. We want to see below 3. That is what we get. And the number below tells us the number of years it would take the company to pay off all of their debt net of cash on hand. What is good to see that is actually 0 in 2024, 0 on a trailing 12 month, 0 expected over the next 12, meaning that right now it wouldn't even take this company one day to pay off all of their debt net of cash on hand. And bear in mind, this correlates to dividend safety and balance sheet strength. We can see at a very high level, their balance sheet does look to be secure. Now let's jump into the valuation. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos when they drop. Now our intrinsic value, $366, will just give you one example of how we got to this value. For the others, we'll just go straight to the margin of safety. 365 DCF model, we have the free cash flow year on year. The average growth very high, 31% over the last 10. Forward looking, we've gone for 12%. We have our low, medium and high today. And we also use the discount rate, which in turn gives us the present value of the future free cash flows. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding. And as we can see, 366, which would indicate 11% upside. Now bear in mind, these numbers are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether that is for Salesforce or any others. Just for transparency, they will show you at 10%, this would come to 318, indicating downside of 4%, at 14% for those that are more optimistic, 421, indicating 28% upside. We will, however, take through the medium rate of 12%, whereas always on this channel, we like to add an MOS, margin of safety, 10%, execute on that if it meets our 3 golden criteria, wide moat, strong financial metrics, and good forward-looking data. Now, if you believe that in today's episode for Salesforce, that is where it sits right now, $330, 10% MOS. For those that do want to see it at a lower MOS, well, 15% buy at 310, at 20 around 293, and at 25 around 274. Right now though, 10% MOS, we did get that insider selling, but we also want you to understand that from our point of view, insider selling isn't necessarily a bearish signal. They sell for many reasons, personal and financial. It is just information we do want to share today. And we also notice Wall Street, they do see upside, although in the single digit at 7%, with their price target over the next year at 352. As always, give us your own thoughts whether this is a buy, hold or sell, 10% MOS, 7% upside. We have also just released our latest free weekly article where we run through 2 beaten down stocks with more than 30% upside over the next year. You can grab a copy by clicking on the pinned comment below. It is free and we do deliver one every single Monday morning to your inbox where we talk about severely undervalued companies that deserve your attention as well as what's gone on in the market over the last few days. You'll also be able to gain access to 40 undervalued stocks for the month of November. Lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that you can grab a recently released copy of 29 undervalued dividend stocks that Wall Street themselves believe right now have the most upside in the S&P. So click below, you can sign up and start reading straight away. The next company with massive insider selling, Bob Iger, the CEO of Disney, in fact on the 22nd, so again just a few days ago, sold around $43 million worth of shares. That is a ginormous amount, and when we take a look at the company itself, it is up around 23% over the last year, so not bad performance. Over the last 10 though, when we do zoom out, not particularly great, up only 25%, as we can see peaked pretty much in March 2021. We're talking nearly 4 years ago at just under $200. Now right now it trades at the upper end of the 52-week range. We do get a double buy signal, very similar to Salesforce, where we did get the 3.47 from Quant, so they're not far off, believing this is similarly a buy. The yield 0.78, marginally higher than the previous company, and in terms of the forward P, sitting around 21.3. Now again, like we just saw with Salesforce, green across the board, they believe earnings per share is going to grow every quarter, and they've also outperformed over the last 4 too. And in terms of the next full annual accounts, they expect the EPS to hit 607, in turn lowering the forward P to 19.01. Now dividend safety, we get a 70 score, and on the valuations we'll cover them shortly, but we do want to highlight they increased their dividend in February this year at a nice 50%. Now, very similar to Salesforce, both companies initiated their dividend this year, although we should say Walt Disney in fact had previously paid a dividend, but we can see a dividend cut looks to be unlikely. Now, key metrics, they maintained the dividend, they had above average growth, and they also had a near S&P return, negative 55, exactly the same as the S&P in 07-09. Now, as we mentioned, they did recently restart the dividend. That is why we get a negative 29% over the last 5 years, where they did cut it not too long ago. And if you do zoom out over the last 20 years, they've been increasing that dividend at a 2%, well below the 4% we want to see just to keep up in line with inflation. Now, in terms of the valuation based on the PE, we do notice right now it is trading at the very lower end of the blue tunnel, which gives us a reasonable signal / slight undervaluation. Now, again, very similar commentary in terms of looking at dividend yield, like we said with Salesforce. In terms of the forward P though, 21.7, it is lower than the 5-year rolling of 24, so again, that is an undervaluation signal. We do notice trading marginally higher than the communication sector, therefore it is trading at a very small premium. In terms of the free cash flow payout, well, we do notice it is very low on a trailing 12 month at 17%, not the highest either on the next 12 months anticipated at 22, so we wouldn't be surprised if we do get another double-digit increase in February 2025. Free cash flow looking very inconsistent. We will see this from the numbers. The COVID years did hit this company very hard, and in terms of recovery, we are starting to see that now, although we do note over the next 12 months, free cash flow itself is anticipated to drop, although marginally, to $4.13 per share. In terms of sales growth, well, inconsistent, no surprises, 2020 was a drop, but just in the more recent year, they have managed at the bare minimum to keep up roughly in line with inflation. And when we do zoom out and look at the numbers, we can see their top line has nearly doubled from 52 to 92 billion. In terms of shares outstanding, they have diluted your position, but in all honesty, if you are a newer shareholder over the last 5 years, they haven't really moved, and that tells us capital allocation, buying back shares is not a priority for management as of today. In terms of ROIC, not great, but we do have to give credit. It has started to recover from the lows of 2% in 2020, 2021, now sitting at 8%. Ideally, we want to see it back to the high teens between 2015 and 2018. And then we get to the operating margin. Again, as we said, post-COVID, this hasn't really been a great time for the company. Although, again, we'd like to see that recovery, 5% in 2021, 13% in 2024. And the same to be said on the free cash flow, although we want to see at least 5%, which they have hit for the majority of the last 10 years, 9% in 24 and 9% on a trailing 12 month. In terms of net debt to EBITDA, below 3 is what we get in the more recent period. It is anticipated to be pretty much the same over the next 12 months at 2.11, which we can say is still below 3, so no issues, maybe something just to keep an eye on. In terms of our valuation today, we get $115, not far off the current price, so this tells us, in our opinion, Walt Disney Company is trading around its fair value. For those that want to see an MOS, well, 10% a buy at 103, at 15% a buy at 98, and at 20% around $92. Right now we see no MOS, and in terms of Wall Street, they see 7% upside with a $125 price target. Give us your thoughts below. Are you also looking to sell like the insiders, or in fact are you looking to hold or perhaps buy? We then move on to a more recent sell just 2 days ago from the EVP, the Chief Technology Officer of Palo Alto Networks, where in fact we see around $65 million worth of shares being sold. And when we take a look at the company, it is down around 3% today, although over the last 12 months, up 43%. Over the last 10 years, massive outperformance of the S&P, up 869. In terms of where it sits, well, at the upper end of the 52-week range. Only Wall Street deems this company a buy, and the forward PE does look very high at 62.4. Now we've gone 3 for 3 today, where we get green right across the board, and by now you know what this means. July 2026 EPS is expected to grow, and therefore the forward PE, while still very high, is expected to come down to 54.7. In terms of look at the metrics, well, we do get some nice growth in the free cash flow over the last 10 years, and that is expected to continue upwards over the next 12 months. In terms of sales growth, we are seeing some issues that we have discussed about previous companies today. Looking good at double digit, but is the growth story starting to come to an end as we do see it slow down? 16% in 2024, 15% on a trailing 12-month basis. And then when we get to the total sales, an 8-fold increase from 2015 to 2024. And again, like other companies, you probably wouldn't care as much in terms of share dilution given the outperformance of the S&P over that period. ROIC, well, just over the last few years, do we see it in positive? 10%, 13 and 14 in a trailing 12 month, which makes us believe they have in fact been reporting a net loss for quite a significant period of time, and that is ultimately shown in the operating margin, where we get negative every year bar the last 2 years. Hopefully we can start to see them move up and report an increase of a net profit moving forwards. No issues whatsoever with the free cash flow margin, definitely looking like a free cash flow machine over the last 10 years as well. We do like that consistency. And the net debt to EBITDA, very, very strong, 0 over the last 2 years and 0 over the next 12 months. Won't take Palo Alto Networks one day to pay off all of their debt, net of cash on hand. Now our intrinsic value, very similar story that we had with Walt Disney, where we do believe it is trading at its fair value. For those that want to see an MOS at 10%, a buy at 346, at 15%, a buy at 326, and at 20%, 307. Right now though, no margin of safety. Wall Street upside, but very minimal. Remember, they were the only ones with the buy target. 425 is what they expect in a year's time, with upside of 10%, and do give us your thoughts below. Now that is the end of the episode, but we do have some other notable mentions today. We can see Microsoft, we get from the EVP, the Chief Commercial Officer, around 10 million worth of shares that have been sold just over the last few days. No surprises, we have discussed this before, but Palantir, the share price is fairly high, valuation does look very rich. We see here Alex Karp just a few days ago selling $158 million worth of shares, and it's not just him, we also get other insiders selling vast amounts in this company, and there are also a few others. As always, if you did enjoy the content, value was provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget to sign up to the free weekly newsletter by clicking on the pinned comment below, and come and join us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day and we'll see you all on the next one.